Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN AM for Friday, July 31st, 2020. And here are our top stories. GDP craters during the second quarter, and the Fed leaves rates at zero, and the wealth divide continues to grow. Joining me now to discuss this and more is Devin Banerjee, Senior Financial Services Editor for LinkedIn, and he's also the editor of the This Week in Finance newsletter, which of course you can find on the LinkedIn platform. Devin, great to see you. Thanks so much for joining us again this morning.
Absolutely, Jeff. Happy to.
Well, I wish we were joining under much more happy times, but I know that yesterday morning, the gross domestic product numbers for the second quarter came out. What can you tell us, Devin?
Yeah, that's right, Jeff. It was a super busy week in terms of economic data, just a slew of indicators coming out. So I'm going to take you through them at a high level. So the first, of course, is GDP. We got that Thursday morning for the second quarter. GDP shrunk 9.5% in the second quarter from the first quarter. That's an annualized pace of 32.9% reduction. This is the steepest annualized decline on record for the U.S. Now, it did come in a bit better than expectations. Of course, expectations were quite bad of 34.5% decline. Personal spending, which accounts for about 2/3 of GDP, that slumped at an annualized 34.6%. That was also a record. So that was a lot of data coming out from the Commerce Department on Thursday. From the Labor Department Thursday, we also got jobless claims, initial unemployment claims for last week. Those increased for a second straight week. If you remember, they were declining, and they have now turned upward. So initial jobless claims were about 1.4 million last week. Continuing claims, those people continually filing for unemployment claims also rose to about 17 million. So these are trending in the wrong direction, let's be honest, and they were trending in the right direction up until a couple of weeks ago. The takeaway, for all of this is really, and the conversation that we're seeing among economists and experts on LinkedIn and other places, is that 5 months into this crisis, for these numbers to be where they are and trending in the wrong direction is quite worrisome. It shows that there is not much grip on this crisis in the United States. And of course, as you and I keep discussing, there's no grip on this underlying health crisis, which is driving all of this coronavirus pandemic. It's also a stark contrast to what's happening in Europe. We've seen a lot of experts begin doing that comparison. Some notes out from JP Morgan and Goldman Sachs in recent weeks really point out to this expectation of a steeper recovery, a smoother rebound in Europe than in the U.S., and noting, which is true, that it's quite rare for the Euro area to outgrow the United States over a 1 to 2 year horizon. But that is effectively what the expectation is right now. Going back to Wednesday this week, just a couple of days ago, there's so much going on this week. The Federal Reserve wrapped its 2-day policy meeting. That meant a press conference on Wednesday from Chair Jay Powell. Of course, the Fed left its benchmark interest rate anchored near zero, that 0 to 0.25% range, where it's been since March 15th, when it took that set of unprecedented actions. I would say, the chairman's press conference, which I tuned into, was just a big reiteration that the Fed is here to do anything and everything, a whatever it takes mentality to support the economy, with Powell calling this downturn the most severe in our lifetimes. And again, we've kind of normalized this now, but for the chair of the Federal Reserve to say quite explicitly that the central bank will do whatever it takes to support the economy that's really not normal in the history of the Fed. And so we do have to keep that in mind. Powell said, quote, "We're in this until we're through this. Everyone should know we're going to be there," end quote. Quite unprecedented. Powell also reiterated that, look, the Fed can lend, but it cannot spend. And he called on lawmakers to continue that fiscal policy support, calling it essential to this economic recovery.
Devin, couple of questions. The first is around the stimulus. Have you heard anything related to possible passage? I know there's some hurdles that have to be fought through or gotten over, but anything there?
Yeah, I'll give you an update on that. Obviously, a lot of politics at play right now this week. This week is quite crucial because those UI benefits, unemployment insurance benefits of $600 a week, are set to expire today, Friday. So, the Senate here, which is GOP controlled, is currently looking at slashing that benefit to about $200 a week from $600 a week until it can be replaced with a program that's in the works, giving the jobless 70% of what they were earning. Of course, these things are very far out, and so they're still bickering over extending that set of benefits, which, as I said, expires this week. Both the House and the Senate, some good news, are endorsing a second round of those $1,200 stimulus checks directly to those earning less than $75,000 a year. But I would say there's still no agreement, as of today. And full disclosure, we're recording this on Thursday. But overall, the House of Representatives, which is Democrat controlled, is proposing about $3.4 trillion in additional further stimulus with these talks. And the Senate, Republican controlled, is talking about $1.1 trillion in total stimulus. So a huge gap to be solved right now.
Yeah, it seems like lawmakers need to get in a room and, separated, of course, by 6 feet with masks on and kind of hammer this out. Devin, what about news about trials for, I think it was Pfizer or Moderna, was doing 30,000 person trials in the final stage of vaccine testing. Does that, outside of the healthcare component, which we'll talk with Lydia Ramsey on the podcast later this week, end, any thoughts about how that could change things and maybe take things back on with some positive news?
Yeah, I would say, which I'm sure you've seen, Jeff, news of those trials and developments in drug R&D and production can have really temporary effects on the market, perhaps that morning or that day. But actually, to give you kind of a peek behind the editorial curtain here at LinkedIn, we actually don't really cover that news very closely because of how early those stages are and how much can change between where those drug producers are now and a viable, successful vaccine. And then there's the whole question about distribution of those vaccines, which we've seen a lot more conversation about how difficult that can be, how ensuring equitable distribution is going to be just another fight, candidly, and another political fight probably if and when we get to that point. So again, a kind of peek behind the editorial curtain. We actually don't cover that very much. Of course, we watch it and see what's developing and which companies are further along, which companies are getting support and funding from the government. There's a real entertaining roller coaster ride with the stock of Kodak, the former camera company, this week because of some funding it's receiving from the government to explore drug production. So again, it changes every day, every week, and so certainly worth keeping an eye on, but no concrete developments there, in my opinion.
Really interesting, Devin. Thanks for that really important topical news. When we come back, we're going to talk to Devin about the growth in the chasm of wealth inequality. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
The windows on our homes, they protect us and the ones we love, but they do much more. At Renewal by Andersen, making your home more comfortable is at the center of every window we make. It's why we custom build our windows in America and install them in as little as 1 day. It's why we build our frames with exclusive FIBREX composite material that's 2 times stronger than vinyl. It's why our glass helps keep your home warmer in winter, cooler in summer, and quieter all year long. It's why we stand behind every window with a 20-year limited warranty. Why not help lower your energy costs while giving your home and family the best? Call 1-800-835-6525 to schedule a free in-home consultation. Buy one, get one at 40% off with this special offer. Plus, get special financing with no money down, no monthly payments, and no interest for 1 full year. Renewal by Andersen, the better way to a better window. Call 1-800-835-6525 now.
Welcome back. We're talking to Devin Banerjee of LinkedIn. Devin, thanks so much for staying with us this morning.
Absolutely, Jeff. Happy to.
A lot of negative news, a lot of negative economic news. And, well, the wealth equality or income equality, which was an issue pre-COVID, seems to have been exacerbated during COVID. What can you tell us here? Because this has me and many others very concerned.
It's absolutely right, Jeff. And you're right that everything we discussed in the first segment is actually very topical to this topic. It is really exacerbating the wealth inequality and disparities in this country. So this story that we saw a really passionate conversation around on the platform on LinkedIn this week is around CEO pay in particular. And if you remember back to March and April, the solidarity that a lot of CEOs were trying to show by taking salary reductions, or those were really all very temporary reductions, while their companies were permanently laying off or in many cases also furloughing workers. And so companies like Marriott, Disney, some of the airlines you remember, Delta, United, their CEOs came out, very prominently. Those companies were proud to announce in a way that their CEOs would bear some of the pain with those workers. Now new data is showing that those sacrifices, which again were mostly salary reductions, were quite minimal in the context of these executives' total compensation, which includes things like bonuses, stock awards, et cetera. In most cases, more than 2/3 of those cases, the salary reductions were less than 10% of these executives' total 2019 compensation. In many cases, far less than 10%. In addition, only a small percentage of companies, even at all, were reducing salaries for executives. So in the Russell 3000, only roughly 419 of them disclosed some kind of changes to executive compensation, which honestly is kind of surprising, given that this pandemic has just crushed sales and profits for many industries, many companies, and has forced them to execute large layoffs. And instead of some salary cuts, we saw some companies defer salary payments at General Motors, for example, where Mary Barra earned I think about $30 million in total compensation last year. They had put in place a program to defer some of her salary payments, but actually on Tuesday of this week they said they're rolling back that deferral, putting her pay fully back in place, or back in place at about a 10% reduction for now, because their business is recovering. So going to the point I mentioned at the top, a lot of these moves were very temporary, and honestly, we see a lot of people calling this just window dressing, lip service during the real depths of the crisis back in March and April. And for a lot of these executives, their pay is back at pre-pandemic levels. Now, of course, the year isn't over. A lot of boards of directors do annual reviews of compensation. Their compensation committees go through a thorough process on an annual basis for senior officers. So that may still be yet to come. Bonuses could be cut, of course. Stock awards, as I mentioned, there could be determinations around reducing those. Some of those, fortunately, are very explicitly tied to sales and profits targets or stock performance. And so, the math translates exactly to what can happen to total compensation in those cases. But again, stepping even further back, this just goes toward this growing disparity that this pandemic and economic downturn are exacerbating. In fact, going back to Jay Powell, the Fed chair, in his press conference on Wednesday, he said something that really stood out to people, which was if you make $40,000 a year or less, you had a 40% chance of losing your job in April or May, according to official Fed figures. A lot of people said that is standing out as one of those quotes that we will always remember, like that one about 40% of Americans who would struggle to put together $400 in cash in an emergency. This disparity has become quite stark right now.
Well, Devin, I guess the first thing that, when people are beating their chests and saying how great they are about taking little vacations from their pay, or whether it's social, talk about socially investing, I always am skeptical or curious about that. But we have talked off and on about ESG, and that's a significant trend. And I'm wondering if, I think compensation often is part of that governance and component of that. And I wonder if ESG and sustainable investors will look at that and say, well, hey, this CEO or this person didn't handle it well. I guess that's my first question. I mean, what are your thoughts about that? I mean, how does that relate back to the whole ESG equation?
Absolutely. No, I have seen that as an attribute in many ESG metrics and evaluation tables. Companies in the U.S. now are required to disclose pay ratios, CEO to median employee ratios. And so that can be a very definitive input into an ESG model for a big investor. And I think what you and I have talked about, as you said, once the investors are paying attention, that can really quickly wake up a board of directors or a CEO to make changes. And public policy comes into play. Actually, here in San Francisco on Tuesday this week, the city approved to add a measure being called the CEO tax to this November's ballot. This would add a tax of 0.1 to 0.6% on top of the annual business tax for companies compensating their executives at 100 times their median employees' pay, which actually does happen for many San Francisco-based companies. And so once public policy comes into play, once investors pay attention, I think this changes the mindset. As you and I talked about a couple weeks ago, diversity of top ranks at companies is also now increasingly being factored into CEO pay. So I think boards of directors, those compensation committees, which can decide these things, I think they're really waking up to a lot of these issues that were not thought about just 5 or 10 years ago.
Yeah, well, this is, look, we're not going to be able to solve this issue in 7 minutes or 8 minutes, however long our segments are. But it's clearly important that people are educated, that they are able to reskill. You've talked about that before on this network and in other places. That's important in order to get more income and be more successful. So there's clearly a lot of work here. And this pandemic exacerbates, as we said at the top of the segment, exacerbates all this. So a lot more to be discussed about this. Devin, always a pleasure chatting with you, and take care of yourself. Have a great weekend, and we'll talk to you again very soon.
Sounds good, Jeff. Take care.
And that wraps up this episode of BRN AM. Have a topic of interest or someone you think we should talk to? Drop us a line. And don't forget, for all the news in retirement markets, technology, personal finance, and more, check out today's edition of The Morning Pulse. Don't forget, we're back again tomorrow with our retrospective show, BRN Weekly. We'll have a very special guest and take a look at some of our best segments. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Waiting here for you to take and drink of. Attention! The Centers for Medicare and Medicaid Services has officially authorized new benefits that Medicare Advantage plans may include. To get the benefits you deserve, you can call the Medicare Coverage Helpline.
Hi, I'm Joe Namath. If you're on Medicare, this is important information. I called the Medicare Coverage Helpline and they instantly looked up my coverage. In this one simple call, they offered to enroll me in a plan that includes rides to medical appointments, private home aides, doctors and nurses' visits by telephone, and even home-delivered meals. The plan also includes dental, vision, hearing, and prescription drug coverage, all at no additional cost.
Don't delay. Call to see if the new benefits are available in your area.
Call the number on your screen now. It's free.
Call 1-800-757-1451. That's 1-800-757-1451.